searchers definitely, I think there's a bit of a talk track that's been forming that, like self-funded search is hard. So like might as well go bigger to try to like buy a bigger deal and like maybe avoid the PG. And I think the what people don't always realize is like the error is rarer up there too, right? Like you are competing with more buyers that are better capitalized and more experienced, and there are fewer businesses, and like deal costs are an order of magnitude larger. So like I mean, to say it plainly, like I think if you don't have M&A experience, you cannot become an independent sponsor on the first go.
And where I've seen a lot of people have speed bumps is they will be a self-funded searcher. That is what they are doing. It's what their website says. It's what their LinkedIn says. And then I'll get an email that says, hey, I have a $4 million EBITDA business under LOI. The purchase price is $18 million. How do I capitalize this thing? And like, what do I do now? I kind of want to be an independent sponsor from a PG perspective and a responsibility perspective, but I don't know how to capitalize it. I don't know how to do that kind of deal, and it's no man's land. Newco Risk is a specialized insurance brokerage focused on the needs of financial sponsors, including private equity firms, independent sponsors, and search fund buyers, and the companies they acquire.
Welcome back to The Intentional Owner. It's Kaustubh Dio with Sam Rosati. How are you?
Hey, Kaustubh, I'm good, and I'm here to ask you, have you spiked the football yet?
I spiked the football metaphorically, big Sunday and Monday. We gave the team a late start on Monday, actually, just in case, they were still drunk from the celebrations.
You mean because they were up late on a Sunday night working?
No, because I invited them all to my open bar Super Bowl watch party.
So guys, for everyone still listening to this humble episode number, 24 or something.
Sounds right.
I've heard that the day after the Super Bowl, so like post Super Bowl Monday, is like the highest called out PTO day of the year. So
what I'm curious to see is what's going to happen on Wednesday, because that's when they have the parade. And so we looked at our schedule. We're like, should we move things around in case people call out? But like, we don't really have our schedule's packed. Like, so I'm just crossing my fingers.
Yeah. And so isn't it cool? You own a business in the Seattle area. You guys won the Super Bowl. You get to celebrate with your team and use it as a way to like benefit the people that support you and have some fun with them.
Totally.
Like add it to the list of things that makes being a small business owner great. Alongside.
Yeah, it was fun. We had, I think, probably about 10 of the team came to the watch party that I threw with their partners too. So it was a fun vibe.
And the fact that you beat the Patriots makes it that much better.
Absolutely. Oh my God, I wanted to win that game so bad.
Yes. Yes.
No, that felt, I mean, it's cool because we didn't come into the season with big expectations, right? It was sort of unclear how Sam Darnold's going to do. And so it felt like kind of found glory and playing with house money. And now it's just like, oh, wait, this is a good team. That's fun.
It is fun.
Before we dive into the topic today, I want to tell you, we submitted on this city, like there's a city RFP for not Seattle, but one of the suburbs. And it was a bunch of big tree removals. And I feel like I bid it pretty tight because I was like, hey, like we're actually just trying to maintain our volumes through the off season. Like I'm not, and it's good work for the guys. They get paid prevailing wage. So they get paid a lot for this. I bid it where I was like, okay, if we win, I will be nervous, but glad. But like, I'm not going to be like jumping out of my chair if we win.
Yeah.
And our bid was $118,000. The winning bid was $37,000.
Huh?
I have no idea. I have absolutely no idea how that's going to. And to be clear, like we're still the second highest bid out of like 14 bids. So we weren't close to winning. I have no clue how these people are going to do this project. Yeah, I don't know what to make of it.
So when like our original platform, WFF, is scaling the commercial business, it would bid at such high volume that the mentality was just rip bids out, never be low. We'll win what we win and we're not going to lose an ounce of sleep over it.
Yeah.
But there are just sometimes like whether an alternative contractor might have like bid a different scope than you, or they're using illegal labor. I don't know if that's a thing. Or you can imagine the host of things that could allow their cost advantage, but that doesn't sound like a cost advantage difference because that's too low.
It's too big. Yeah, and I mean, the thing is, like, the scope, the city that put the RFP together, they made the scope super clear, actually. It's all tree removals. They specified, like, for certain trees, you have to get rid of all the wood. Certain trees, you can leave the wood. Like, they were very good at creating a scope. So I think the scope is consistent, which makes it even more kind of, I just don't understand. But I mean, look, like, there are a couple of real tree companies that bid way below us as well, and these are much smaller than us. So I think it is definitely like owner-operator kind of just getting after it. But the one that actually won the bid, I looked them up. They're a construction firm. And I looked them up, not a tree company. They have on their website. So like, I think they're going to sub it, right? So they're going to sub this at that price, which means they need like a room for margin. But on their website, it says they have 3 completed projects, 2 of which are carpet reinstalls for like big municipal buildings, and 1 is like a foundation repair for an apartment building.
So they're going to lose their ass on this.
I think so. Which, like, you know, I mean, I'm going to reach out to the city arborist and just be like, hey, man, well done. Like, you won this RFP. Like, you just probably saved the city like 50 grand.
Yeah. Also, like, if you're going to get beat by what, 2/3, that's great. You know, it's going to tie up somebody else. You're going to win yours just based on odds alone. Fine with you.
No, it's totally fine. Interestingly, our larger competitor, Seattle Tree Care, they didn't even bid on this, so they must have realized that this one's going to get lowballed.
Yeah, totally. The only hard part is I forgot who you said actually did the estimating, but, you know, you put actual hours into it, so there's a cost.
Well, the person who did the actual estimating was me.
And that, my friends, is why they define it as seller discretionary earnings.
Exactly. Yeah, on Wednesday, I was going out of town Thursday, Friday, and I'd sort of lost track of this bid. I was like, oh gosh, like this has to happen. So I got 10,000 steps on Wednesday visiting and like putting this bid together on like, it was something that ended up being like 55 or 60 trees.
Wow.
Yeah.
Okay, so Kaustubh, today we're going to talk about something unique to the sort of dynamic you and I have at play every other week when we record this podcast, which is while we both left our prior careers to endeavor into ETA, entrepreneurship through acquisition, broadly defined. Today, we represent pretty different models of ETA. So we figured that we would talk maybe not so much about like the technical side of that, but the lifestyle sort of day-to-day responsibility differences in the way you're doing ETA versus the way I'm doing ETA. And maybe what I'll do is just share to start. I'm going to play the role of independent sponsor here, which I'm technically not the independent sponsor of PSG anymore. We now have a new owner, a private equity firm, but I'll kind of speak to that evolution and, you know, life as an independent sponsor. And you're going to play the role you've been in the last few years, which is owner operator via a self-funded search.
I love the topic because I went on a webinar a couple years ago and mentioned that if you have enough liquid capital, you should be an independent sponsor, not a self-funded searcher. But the way I phrased it is, I said, don't be a self-funded searcher if you have more than 6 figures of liquid capital. So I get a bunch of LinkedIn DMs now being like, hey, so what would you suggest that you do? And so now I can send them this podcast.
Yeah, AKA you can backtrack or backpedal at scale by sending them this link and get us more listens at the same time.
It's the one to many, you know, that's the whole game.
All right. So let's step back and first set the table. What are the fundamental differences between self-funded ETA and independent sponsorship?
Okay. So I view them, they're very similar in that I think of self-funded search as like the baby brother of independent sponsor. To me, the key differences are a self-funded searcher, they intend to go in and run the business. They're going to be the operator. So they're doing only one deal, at least at that time. Whereas an independent sponsor are generally planning to bring in some kind of an operator, and then they intend to do multiple deals. I think that's like the core difference. But then there's a downstream effect of that creates a ton of other differences. But I think that's like definitionally the difference in my mind.
I think so. So to be clear, you, Bluma, you acquired it. You are the daily operator, the president and CEO, also the majority controlling shareholder. And you have one business primarily.
Correct. That's right.
I, the independent sponsor, I would say, by the way, like I'm probably not like the vanilla version of an independent sponsor. I don't have multiple platforms, multiple businesses. To start, I was definitely far more in the business than the typical independent sponsor. I've always thought of an independent sponsor as a private equity firm or private equity professional that just doesn't have committed equity capital.
Well, so when I worked at Bain Capital, we actually backed a couple of independent sponsor deals. And back then, the more like derogatory term people used is they called it a fundless sponsor, right? You have a funded sponsor and a fundless sponsor. They now they rebranded fundless sponsor to be independent sponsor.
Yeah, what's interesting is the last, 5 or 10 years we've been a part of the ETA, the growth in the ETA community. It's undoubtable that the community has exploded. I think what's maybe hidden a little bit in all of that is how much the independent sponsor community has grown. There's just less, media promotion around it outside of like the sponsor circles. Okay, so all that's to say there are some pretty stark differences. So we kind of have some notes on different ways we're going to compare and contrast. So let's just talk about it. What are your day-to-day responsibilities at Bluma?
Yeah, so my day-to-day responsibilities as of right now are I manage the team. I call myself president, but I'm general manager, right? Like that's my role. The operations manager directly reports to me, the sales team directly reports to me, our customer service manager directly reports to me. So I have, several direct reports within the business who are not even all managers, right? So it's like I'm a manager of sub-managers and I'm a manager of individual contributors.
Okay. And my role as an independent sponsor in the early days of PSG was much more of a blend between your role and call it like a private equity type independent sponsor. I shared the PE roles of sat on the board, the sponsor entity, which was my partner and I, controlled the business. And yet, because it was still a fairly small business at the time, we were very much in it. The one thing we had zero responsibility for, operational responsibility for, was like day-to-day operations. Everything else, sort of back office, finance, accounting, capitalization, shareholder, investor relations, M&A, strategic, all of it, everything else, that was what our day-to-day responsibility was.
Right. And by contrast, my first couple of years, like I was opening the gate at the yard, every morning and locking it every evening.
And to be even clear, the traditional independent sponsor would have far less day-to-day responsibility. You could think about them as they sit on the board. They may coach the CEO. I should have mentioned as an independent sponsor, my version, my other partner, the third of the three of us, he is and was and is the CEO. So his daily responsibility was to be the president and CEO of the business. And all of those things reported to him that you mentioned.
No. Yeah, the more traditional independent sponsor, right? Like you're saying, it looks more like independent sponsor, the actual person is kind of chairman of the board, kind of runs the board meeting, and is probably doing like a weekly to monthly meeting with the CEO. And so acting kind of like the hands-on kind of training wheels.
Yep. And then I would say there are flavors of other responsibilities, definitely like they'll manage the lender relationship.
Mhm.
They'll definitely do investor relations that they are the investor. So that's kind of the same thing.
Mhm.
They will definitely lead M&A and any kind of strategic projects. But
Yep.
I think we've kind of hit it. I would say like an independent sponsor by definition is, like Kaustubh said, going to have maybe 2, 3, 4, 5 platforms. So they are just not going to spend 40 to 60 hours a week on a platform. They might spend 0 to 5 hours a week, or 10 if there's a deal.
Yeah. My sense is that the way they operate, if they're trying to build like an independent sponsor firm, right, where they're really trying to do this at scale and repeated, they're closing their first deal. They're maybe spending the first 6 months to a year really hands-on with the CEO, but then they're quickly trying to pull back to then go look for the next deal and then the next deal. Like they're looking to put these in serial order.
Yep. All right. So the next one is time horizon. Let's call it, are they doing this to hold it forever, to have flexibility? Or are they doing this like a private equity firm does to have a specified hold period? They need to sell it and move on. You first.
Yeah. So for me, because of the self-funded search model and kind of how governance generally works in these deals, like I have investors. There are other people that own parts of Bluma, but I own a majority. I have full governance control. And like part of the kind of my understanding of my investors is like I never guaranteed some sort of a big liquidity exit event. So I have the option basically to own it for 30 years if that's what I want to do with it.
Got it. And so, if you don't mind, are your economics in what they call carried interest? Are they in sort of a pref common equity structure?
Yep. Mine, like most self-funded search deals, it's a pref common structure where the investors have preferred equity. So I have to pay them back before I can take any distributions. But then once I have made all my distributions to get them, their capital plus a accrued return back, then we're kind of at our common equity splits, of which I own the majority.
So it's a really interesting setup where these are the wrong words to use, but I think it lands with a lot of people. In that pref common structure, it's almost like the investor group has loaned the business money to acquire Bluma. You have to return that principal plus an interest component. And once you do, then everybody owns pro rata according to the percentage splits. And at that point, you've really kind of hit your hurdle. And as the searcher majority owner, that's where, whether you decide to own it for the long haul and make distributions, you then are entitled to a majority of those. Or if you sell it, you're entitled to the majority of the proceeds. And you're in a great spot.
Absolutely. Yeah, that's right. And to be clear, like as a majority owner, you're still a fiduciary, right, to the minority shareholders. So that's not a small thing. That's a legal responsibility and an ethical one. But I do imagine a future state where once I've returned capital to get, pay off the pref, to be able to go to the common equity holders and say, hey, like, can I buy you out? Right. And like, that would be a cool way to create liquidity and still own the business.
So I guess my setup looked completely different. And maybe we'll talk on economics in general, because I think there's more than just ownership, but I think that's the main one. That's why most of us are doing this, right?
Mm-hmm.
So when we were still an independent sponsor platform, my ownership was, I had a very little amount of preferred equity from the cash I invested at the acquisition.
Mm-hmm.
But my cash as a percentage of the total equity capitalization was a very small percentage relative to maybe most self-funded searchers' equity injections, because the size of the business is bigger. But in line with how independent sponsors and PE firms are typically compensated, we had a carried interest setup, sort of around typical terms. You can kind of find out what that looks like on the internet. There's surveys. But the difference is carried interest it's not common equity. It's like a contractual right to waterfall distributions that are the incentive. So while I think you could probably end up just distributing enough cash at a certain point where you hit those hurdles, it's principally a sale or recap bonus with some nice tax attributes to it.
Yep.
That is very much the norm in independent sponsor land and private equity. So
yeah. No, it's fundamentally different in that regard, where for most independent sponsors to kind of crystallize the value of their carried interest, they need that big liquidity event. Whereas like my version of carried interest already exists, right? Like it's already there. It just has to I haven't gotten to paying it out yet.
Yep. And mine was heavily determined by performance. So how much of a distribution I got heavily depended on how well the whole platform performed, which is great alignment. What also I think people might mistake when they look at these various flavors of ETA is they think majority common ownership equals control, and you can't have one or the other. You very much can. Like I did not own a majority of the common equity, but I had with my partner control contractually. And that's
I call it economic terms and governance terms are two different sets of terms. They're both in the operating agreement generally, but they're different.
In 2025, Andy and Josh spun out Newco Risk from a top 100 specialty insurance broker with a mission to build an enduring brokerage platform to serve investors and operators that have been marginalized by alphabet house brokers and underserved by local and regional agencies.
Newco Risk services start with pre-close insurance due diligence, an expertise its founders have honed over thousands of deals while at some of the largest global brokers in the world, including Aon, Hub, and NFP. Insurance due diligence bridges the gap between legal and Q of E and can uncover hidden pitfalls, overstate EBITDA, and operational risk deficiencies that must be addressed to ensure a smooth transaction and successful acquisition.
So Newco Risk facilitates and executes across all lines of commercial insurance products while bringing their clients ongoing risk management services tailored to the operating company.
The Newco team are veterans in transactional risk products, regularly negotiating representations and warranties insurance, directors and officers liability insurance, cyber insurance, environmental liability, and other commercial policies to address to the contingent risks inherent to deal making.
Newco Risk's distinct value is in its deep understanding and experience with transactions, enabling them to provide expert guidance and customized insurance solutions that protect both the investor and the operating company.
They bring nearly 4 decades of expertise in insurance and transactional consulting, earned across thousands of deals from Main Street to Wall Street, from self-funded searchers to the largest global private equity firms.
Okay, so then how else does Kaustubh get paid for his effort?
So I get paid a salary, which was contractually agreed with the investors. And what's typical in self-funded search world is it's somewhere between 80 to 120K I've seen. And it generally has a 5% a year escalator, but that's it.
Got it. Anything else like personal expenses, a car or...
Yes. Oh, yeah, that's true.
Through the business.
Yeah, my car and phone are through the business. I think that's it.
Cool. So in my case, no salary, not on W-2. I don't have benefits. I didn't have, I'm using the perspective of before we sold. Didn't have benefits, wasn't on W-2, didn't have retirement, nothing. It was essentially a 1099 management fee that kind of per the norms of the marketplace was a percentage of EBITDA with, I think we had a floor and a cap, floor and a ceiling. Very typical. And so the alignment was there to grow the business. I think the alignment around a management fee as being a percentage of EBITDA obviously rewards organic growth, but it rewards M&A. So we were clear about the strategy from day one with our partners. And so that's why we set up that alignment.
Right. And I will say, what's interesting about that salary versus management fee component, right? I can't contractually increase my salary, but I can certainly reduce it, right? And as the majority owner, I've made that choice over the last year, 2 years. I've taken a lower salary that I'm contractually allowed to take.
Yeah. So back when I was a small business owner via self-funded ETA, I actually thought, gosh, I would love to have this contractual management fee. It's really neat. Until for the first time, I remember signing loan docs as an independent sponsor and seeing, holy cow, like as soon as we trip a covenant, like in the loan doc, it says the management fee gets turned off.
Yep.
It was fascinating.
First thing to go. No, that's right. Yep.
All right. So we'll leave economics for a while and talk about the role of M&A in each kind of ETA. So what is the role of M&A, and did you talk about it pre-Bluma, and what does it look like now?
Yeah, so pre-Bluma, I viewed potential M&A like add-ons as a opportunity, but not one of my core thesis points. Like I didn't really know if that was going to work well or not. And I kind of still am sort of in that camp where I look at it opportunistically if I find it a good deal, a good fit, but I'm not running it as a roll-up by any means, right? And so organic growth is still our primary driver.
And so have you done M&A?
I have. We acquired one kind of, decent sized competitor where we brought in their team and their trucks and everything. And then we acquired one, just a book of business where we didn't, buy like the whole business. We just sort of took over their client contracts.
So in many ways, it's like a consolidation of local competitors to increase your capabilities, but it's not a roll up. It's not a buy and build.
Correct. I'm looking to build Bluma itself in Seattle as one really strong regional company.
And what I would say is most independent sponsor platforms are using the private equity playbook by executing buy and builds or roll-ups, whatever terminology you like to use. That was our intention for BSG. We started quite methodically. It took us a year to do our first add-on. But then by that point, we had grown organically a lot, which was a magical financial engineering tool that we can talk about in a little bit. But we have done a lot of M&A. So we obviously bought our platform, then an add-on and sort of that 12-month point. And then we started turning it up and we did a bunch of acquisitions all across the country to get pretty big pretty quick.
Yep. No, that's great. I mean, look, like I was coming from private equity where I've seen that play out. And I think I'd seen some of the bad versions of that. I'm not actually at the firms I worked at, but I've just especially when I worked in distressed debt. And so I think I was a little bit I over-rotated away. I was sort of like, oh God, I'm not going to do that. But in reality, there's actually some middle ground of you can do a smart roll-up and build a really great business that way.
Yeah. And what is neat in tree care is you can tell, all you have to do is go to some very reputable private equity firms and look at the industries their portcos are in and realize tree care has become a industry that's in the middle of being rolled up. It's not late innings. It's probably not the first inning. Probably closer to the first inning than the ninth inning.
Yeah, no, I think that's right. There's one roll up that has been around now for probably 10 years. But outside of that, the rest of them are all kind of less than 5 years old.
Huh. So I think one of the things, if you're out there and you're looking to do any version of ETA that you can use as a qualifier for the industry is if private equity is rolling it up, but it's still early on, it gives you a nice floor to your valuation in theory.
Yep.
All right. Kind of getting here to the end, but I think this is a big one, which is capitalization is fundamentally different. What does yours look like?
Mine is pretty classic how self-funded search deals work, where SBA debt plus seller debt makes up a really large percentage of the deal, 80 to 90% on most of these deals. That only works because your multiple is low enough so you can cover your debt service is still reasonable. And then the remainder of the equity, I put in some cash and then I raised cash from investors, like I mentioned.
Any seller financing?
There is seller financing, yeah. So it was around rough numbers. It was high 70% of SBA debt and then kind of another 10-ish% of seller debt.
And so in the independent sponsor world, ours was fairly typical, especially of a platform acquisition. We started with less leverage as a percentage of purchase price. So it was conventional debt, not SBA. When you do conventional, you just lose some restrictions like earnouts. So we were able to use earnouts as a tool. Because you are leveraged lighter, you then are not forced, but you need to raise more equities. So we had a lot more equity as a percentage of purchase price on the platform. And then where the magic happened is as we were growing organically, it creates the ability to use more leverage and buy future acquisitions using mostly debt because your various covenants and underwriting metrics work really well once you grow organically. So, yeah.
And did you have to PG your debt initially?
No, we did not. I hesitate to say that because I don't want to give the perception that that's the norm. I think that there was like a confluence of factors in that we were not first-time business buyers. We had done this several times before. We had built a track record. My partner was a veteran of the industry that we bought in. And the platform was a very reputable business with a great, it checked a lot of the boxes that needed to be checked to get non-recourse senior leverage for a first-time independent sponsor.
Right. I think the right way to say it actually is or conventional financing, the personal guarantee is negotiable, but it is likely still there. Whereas the SBA, it's non-negotiable.
Great point. Great way to think about it. And I would say, so private equity firms never sign personal guarantees. And I think, and maybe this is into the next question, which is we were going to get at what backgrounds suit each path, or sort of like, are there any requirements in the backgrounds of people that are needed to be successful in each path? What I've found on the independent sponsor path is the person making a pretty significant career shift, maybe from like corporate career or consulting into small business ownership. The first time they do that, it's not easy to do that for the first time and become an independent sponsor. Typically the successful, I say successful in the sense that they got their deal done, not it went well. Independent sponsor typically is coming from private equity or investment banking. They kind of have that track record speaks well to conventional lenders who want to capitalize indie sponsored deals.
Yeah, 100%.
And I think it's harder to make a big pivot from something not like that into independent sponsorship. My own path was through self-funded ETA first and then into indie sponsorship, and it worked really well. So
no, I think searchers definitely, I think there's a bit of a talk track that's been forming that, self-funded search is hard. So might as well go bigger to try to buy a bigger deal and then maybe avoid the PG. And I think the what people don't always realize is the air is rarer up there too, right? You are competing with more buyers that are better capitalized and more experienced, and there are fewer businesses. And deal costs are an order of magnitude larger. So I mean, to say it plainly, I think if you don't have M&A experience, you cannot become an independent sponsor on the first go.
And where I've seen a lot of people have speed bumps is they will be a self-funded searcher. That is what they are doing. It's what their website says. It's what their LinkedIn says. And then I'll get an email that says, hey, I have a $4 million EBITDA business under LOI. The purchase price is $18 million. How do I capitalize this thing? And what do I do now? I kind of want to be an independent sponsor from a PG perspective and a responsibility perspective, but I don't know how to capitalize. I don't know how to do that kind of deal. And it's no man's land.
It's absolutely no man's land. And I think that's where there's a gap between SBA size deals and kind of conventional independent sponsor size deals a little bit because of that, right? Anyone who is capable of figuring out the capitalization on a 5 million EBITDA business, that's what they're going to do. They're not going to do the 2 million EBITDA business, but the 2 million EBITDA business is too hard to capitalize with the SBA because it's too big. And so you end up in this weird no man's land that it is actually quite difficult unless you can sell it to a strategic.
Yep. So I think that's probably the opportunity, is that no man's land where the SBA plus pari passu loan is still not sufficient to get a deal done, but it's still small enough and probably hairy enough where some big strategic or private equity platform isn't scooping it up.
Yep.
But even then, I think, whereas I always say the SBA 7A loan is kind of akin to the 30-year fixed rate mortgage. Without the government support, it probably wouldn't exist. The fact that I totally lost my train of thought when I looked at my fish on my wall. What was I saying?
You have, wait, what fish? Where are the fish?
I have a fish on my wall. And I like for some reason started looking at it and saw my reflection and lost my train of thought.
You're so lost in your own vanity.
Do you see that? That's fine. Vanity was lost a
long time ago.
In fact, I have my hair trimmer here.
Nice. It's how you keep your head as bald as possible.
Totally. Okay, so going back, so the SBA 7A loan without the government support would not exist, just like the 30-year fixed rate mortgage. So it's kind of a magical piece of debt, and it's so important to ETA that it sort of dictates everything else. In independent sponsor land, like there are far less rules. It can be whatever, but it's much harder to get a non-SBA lender to lend you money on a business acquisition, whereas the 7A loan program was designed to lend money to people who don't really have a lot of experience, per se, in buying a small business. So
totally. I mean, and you got to remember, right? Like the reason conventional doesn't lend as much is because they don't have the federal guarantee, right? Like they are just fully at risk. And so that just is true. Yeah. I'm curious, how well do you know the SBIC type lenders? I'm not that familiar with it, to be honest, but do you have more familiarity?
I have never been a borrower on an SBIC backed loan. I think I know enough to speak to them, which is they are conventional lenders. They are not SBA 7A loans. They don't have that cap per se. They typically they operate under the guise of like a private firm. So like ABC Capital will be an SBIC fund. They have the government backing. I don't know if it provides a guarantee. I don't think so. I think
my understanding is it's like more of like a matching program. Like if they lend from private capital sources like $5 million, they can also get another $5 million lended by the government, something like that.
Fund level leverage is, yes, exactly how I thought about it. But then they tend to also bring in deal level leverage sometimes. I don't know.
Okay, this might be, if you know a lot about SBIC, maybe you should come on this podcast for a bit and tell us about it.
Yep, exactly. I also know that some SBIC funds, their main tool is as a lender, but they'll also do equity co-invest. Yeah, so a lot of independent sponsors will go to an SBIC fund for their leverage. The SBIC fund will give them a small, maybe 5 or 10% of the total equity check needed. And then they can kind of use that term sheet to go raise equity off of.
Mm-hmm.
So,
anyway,
it's
a lot of different forms of financing once you get out of the SBA world.
Yep. So,
and they're all harder than SBA. That's almost like people complain about the SBA underwriting and kind of closing process, and it's like it is bureaucratic and difficult. But like, I don't think people appreciate just like how off market and easy it is relative to normal debt markets.
Yeah, I think the misconception is that the SBA is hard when really it's just painful. It's not hard to qualify for an SBA loan. It is hard to qualify for a conventional non-recourse piece of debt.
Yeah, I think it's maybe because most people's experience of debt is in real estate, which is very different. And I think maybe that's where they come from. Like, wait, why isn't this lender getting on board? And it's just the risk profile is completely different in businesses, which is also why the multiples are so much lower than real estate.
Yeah. All right. So hopefully that was a decent comparison. And what's funny is I think our lives are fairly different in the day to day, but it's just different flavors of ETA. And I think we both consider ourselves small business owners, no matter how the setup looks. And so, yeah.
I'm curious, actually, one other kind of difference that I wanted us to tease out is kind of dead deal risk up front, because I think that can look quite different and the magnitude can be quite different. So I'll let you go first. Like, what kind of what are the rough quantities of deal costs on these on independent sponsor size deals, and how much are you on the hook for? How much can you offload that risk?
Yeah, what's funny is for SM Bootcamp, I have a deal expense calculator that is targeted towards self-funded searchers. And it kind of gives like a high-low on expected deal costs. And then it will kind of describe each one, like when the payments are due, and kind of articulate one of this is dead deal risk versus not. But for, let's call it a first-time independent sponsor, you are the same as a self-funded searcher. You're just out there paying your own costs, email, you're paying travel, conference attendance, all of the usual things. Where you take a bunch of risk is when you go under LOI, and maybe you can negotiate, draft, sign your LOI on your own, not have to pay legal for that. But as soon as you sign your LOI, you're making a call to a quality of earnings firm to run a Q of E. This is where it's probably gotten better for the independent sponsor. It used to be where there were very few options, and you were signing up for a $50 or more $1,000 fee easily. And back 5-10 years ago, there weren't sort of first-time friendly deals where you could pay half up front and all of this. So you were taking real risk, right? And in most cases, the full, whatever it is, $50,000, $100,000 was due when the report was delivered to you, which could be way ahead of closing. So not only are you taking dead deal risk, but you had to fund these costs before closing.
I mean, or the QV comes back and says, hey, EBITDA's 30% lower, deal is dead, pay us $100K.
Exactly. Legal, same thing. Like retainers, the fixed fee concepts are newer, although they're kind of going away. So legal could easily be $100,000 to $300,000 risk. And then you can imagine there are a bunch of other diligences and things like background checks. And it is not impossible to imagine a situation where on a busted deal late in the game before closing, you had easily $250,000 at risk.
Easily, at least.
Easily. I think I'm probably being modest, but I'm trying to reflect. I think the market's gotten better. Like there are more firms now that'll do alternative arrangements to keep your busted deal fees down. Mm-hmm. There was a few things about this though. One is in the independent sponsor world, when you team up with a capital partner, maybe at the LOI stage even, some of those term sheets will share that risk with you or even fund it for you. That's part of a negotiated relationship you can have with a debt and or equity partner.
Cool.
Not bank.
I didn't know that. Okay.
Yeah. And
I guess I assume there's some kind of a trade that gets made on like the carry or whatever else.
Yeah. It can look 1,000 ways, like a dollar for dollar payback or just kind of baked into the economic split.
Got it.
But yeah, like well before PSG, actually, it busted on us, ironically, but it busted very early, thankfully. We had another business signed up. We were going to do an independent sponsor platform partnering with an SBIC fund. And in that term sheet, they were going to share some costs with us.
Interesting. Yeah. I mean, so by contrast, the self-funded search, I had a deal die on the 1 yard line, as you recall.
Yep.
And that deal, my final kind of net cost burnt on that deal was around $40K, which $40K is a kick in the shins, don't get me wrong, but it's not a minimum of $250K.
How old were you?
27.
That's a lot of money.
Oh, yeah.
It hurts.
Yeah. It really, that sucked. But that to me, that's where when I talk about like this idea of like, if you're 6 figures liquid save that you can kind of like that works for self-funded search. It's not actually enough money to be an independent sponsor, I think.
I agree, which is why it's just not, there are two, maybe this is the punchline. There are a lot of people that want to do ETA and don't want the PG, want to do ETA, they want a big business. And so they say, I'll just be an independent sponsor. I'll buy a big business without a PG. This is great. And they don't think through all of the risk involved. And this is probably the biggest one.
Totally. Yeah, I'm curious what proportion, like I guess the alternative, right, is like if you're a really good operator, you come from that background, is it kind of getting hooked up with like a M&A professional and sort of start an independent sponsor firm as partners? Is that the best path?
Well, I don't know if I know the best path. Maybe conceptually, yes. One of the best paths probably is operator and deal person. I also like deal person and industry veteran. Those are good combinations, but the problem is a great independent sponsor firm offers a lot to the businesses they buy. And the idea that one person can do all of those things is far-fetched.
100%. 100%.
Can I also offer one other thing? People think that the economics of an independent sponsor are great. I just want to share that when we closed the platform and I had a partner, we were splitting a very modest management fee. So I was making far more, I'm going to quote, salary when I was a self-funded searcher than when I was a first-time independent sponsor. So the idea that you're getting rich off of a management fee early on when you buy the platform, not true.
I will also not, this is like a soapbox I could get on, so I'll try to keep it short, but like the concept of the equity step up in self-funded search is bonkers. It's not how any other capital market works. It's only self-funded search, and I don't know why we've all agreed to do this, but actually, no, I'm already riled up now just from that. But you should know, right? The standard in most deals is the starting point is who funded the equity, right? So if you start with somebody funded 100% of the equity, they get 100% of the equity. And then you know, whoever's running the business, whoever put the deal together, whatever, like they take carry off of that. And so those percentages go down. For some reason in self-funded search world, we've landed on this concept where it's like, what percentage did you fund of the whole deal? So you could fund 100% of the equity, but only 10% of the deal, which is just a bizarre way to look at it. And then you say, we step you up from 10% to 20%. I get why. I get the arguments like, oh, you're PGing it, blah, blah, blah. Like, fine. It's just like not a way anyone else outside of SBA world thinks about it. And so people like, I think they get surprised sometimes because they're coming from self-funded search world. They get to independent sponsor world and they're like, wait, these LPs are saying I can only own 20% if the deal goes well. And they're like, why are these guys trying to rip me off? I was like, no. That's the deal. Like, that's how this works. It's the economics are completely flipped because you don't have a PG and the pie is way bigger.
And so in self-funded search, the reason the equity economics are the way they are is for a long time, there was far more demand for investment than supply of deals. And I think that's probably still the case, right? Yeah. There's also, I think, more risk to the business owner, the searcher.
Absolutely.
Because they carry all of that word. They hold all the downside risk, but only a lot of the upside, but not all of it. And I think what we just need to do is maybe retitle the word step up to something else. All we're doing is just reallocating equity to the searcher to compensate for the excess risk as a personally guaranteed business owner,
right,
who also runs it. And
totally.
Maybe the other thing is, well, no, I don't want to get into this. This is definitely a can of worms, but the market for investing in self-funded searcher deals, in my mind, has devolved a little bit. And it feels like that equity that we invest has kind of become mezz debt with a kicker in its return profile.
Yeah, no, it's less and less attractive to invest in self-funded search. And I think that is, the market will find a new equilibrium, right? But I think one thing searchers miss is the reason they get such incredible searcher terms on the common equity side, including me, right? I was the beneficiary as well. It's because you're taking a ton of debt. That's the point, right? It's so levered and you're PGing it. That's why it works. And so I think sometimes people get confused when they're like, oh, well, I'm only going to lever it 50%, but I still want similar economics. And it's like, no, you don't get it. They're not doing it because they like you or because they like your deal so much. They're doing it because your leverage is out of control. And so as a result, they're getting to access leverage off of your PG. That's what's happening here.
Good point.
That was, you can tell it was soapbox here. I'm sorry.
I think it's important. I think because you came from sort of Wall Street private equity, you have a really good perspective on it. The rest of us idiots had to figure it out on the fly. So let's end with a little bit of a conversation around, yes, we both talked to a bunch of searchers. So my takeaway is most people get into ETA for the independence and the agency, the fulfillment. Agency means fulfillment, the ability to control their destiny, the independence of time and schedule and decision-making. But let's not forget, we still have to eat. We still have to feed our family. And so I think it's worth a quick conversation on like, what is the compensation, the salary, the owner benefit? Like really, what is a business owner? What does it mean to be a business owner financially? And where I want to start is most people are I'll probably take like the ETA hat off when I say most small business owners that we talk to who are selling, they pay themselves less than they should because salary is very tax inefficient. So let's be clear, if it were just you owning a small business, you'd probably take a lower salary and take it in the form of distributions. But I think there's a second way to think about compensation, and that is that the ownership or the equity splits reflect compensation that's on paper and not in cash.
Mm-hmm.
And it's a long game. So a lot of us came from careers where when we got into ETA, we took a big compensation cut to do this. But let's not forget, we didn't take a compensation cut. We took a cash comp cut. And we're trading that cash comp for ownership that has potentially a lot of value, but in the longer run. And the reason why people feel some pain in the early days of small business ownership is they buy a business using a lot of debt. And so even though the business was generating $750,000 of EBITDA, 550 of it goes to principal and interest payments every year. You invest another 100. So there's $100,000 of cash to distribute at the end of the year. And for the first few years, you're trying to pay down more than the required debt pay down. You're trying to pay back your investors. So the equity compensation that is the most valuable form of compensation as a small business owner produces no cash for the searcher. And it feels very stark to a lot of us.
Absolutely. I mean, I think your ability to keep lifestyle costs down during this phase of it, I think meaningfully moves the needle in terms of your experience. Like I feel very lucky to have embarked on this before having kids. I think it would be much harder if that were the case.
It's a great point. That's a really good point. So if you just said, I forgot, the salary of 80 to 120 was typical. Was that?
I think what I've seen on most deals is probably like 100 to 120.
It's got to be, right? So, yeah. But the point is that cash comp level is just like it in itself is nowhere near enough to be doing that for the long haul and taking this kind of risk and putting in this kind of energy and stress. So what I worry about is we hear this like, all I want to do is replace my salary as a small business owner. And one of the only ways you can do that is to either buy a business with a lot less debt than most are using, or to be the 100% owner so that all distributions above P&I payments can go to you.
Totally. And to basically buy it with a lot less debt, you need a lot more capital up front, right? So it's either you put the capital up front or you generate capital value on the back end, right? But if you try to generate the capital value on the back end, you can't get the cash flows today.
Yep.
Yeah. Yep. So no, that's right. Like you can have the goal to eventually replace your salary, but the first, 5+ years, like you're not going to be at the same cash comp in most cases.
I agree. That being said, if you can just grow a business organically, it's pretty magical.
Yeah. I do think actually, I'm curious, this is a little bit off topic, but yeah. I kind of believe that there's going to be the secondary form of self-funded searchers that are kind of into their 50s that are maybe close to empty nester or are empty nesters, where their lifestyle costs actually fell dramatically after their kids left the house. And so they actually have the ability to go buy a business with a lot more capital because they actually have savings at that point too.
Yeah, we're seeing this at SM Bootcamp. There is
Really?
and maybe it's just folks that align with us, but a cohort of people that are in their 40s and 50s, which is probably not what you mean, because in your 40s, you still have kids in the house.
Yeah.
So it's what, in the 50s, where you have had a 30-year run in a career, kids out of the house, but you're 50. So you still have energy. You've saved a lot. And I think the maturity is next level to make good decisions.
Totally. Like, I would much rather bet on that person than me. For sure. Especially because they're going to buy it with less leverage. I bought with more leverage, and they've got 30 years of experience on me.
Yeah. Yeah.
I don't know.
We'll see.
I don't know how much of our listenership is over 50, but consider it.
Yeah. If you are, and you're that much more mature, can you send us some questions or comments?
Tell us why you haven't already bought a small.
Exactly.
Well, yeah.
Give us some feedback.
Cool.
I think that's it for today. Newco Risk is a specialized insurance brokerage focused on the needs of financial sponsors, including private equity firms, independent sponsors, and search fund buyers, and the companies they acquire.